All right, guys. I know that took a little bit longer. As the saying goes, patience is virtue. um, there, it took a little bit, but here, why don't I extend this out to you guys? Let's just get at least two people. Was there any takeaways from you that you learned from this? A product that was interesting, something you can use out in the field? Any two people? I really don't like calling on names, so just go for it. Yeah, Freddie, thank you.
So yeah, just a follow up and a takeaway with the DSCR program. It's pretty attractive because I'm used to cash flowing properties, and I add an expense ratio for any investment deals that I cash flow, things like that. And then I was surprised that they use the entire gross income
Yeah,
to do the cash flow, which is fantastic.
yeah, yeah, definitely. That is a good one. Some there are lenders that use 75% of the market rentals, and there are some that use the full. Yeah.
Yeah.
Anyone else? A second person? A takeaway? Something you learned? No one? Should I just start picking on someone? uh on a takeaway.
I guess Peter brought it up, right? Blended FICO. That's
Okay.
the first time I heard that. Heard
Yeah.
term.
Yeah. Did everyone get how that worked? Can you explain that on how the blended FICO works?
I couldn't catch what he was saying.
Uh-huh.
I just bits and pieces. So what I understand is that it's two borrowers, something about the middle credit score. If you take the average of the two, and as long as it comes over, I forgot what the market was, but then they can borrow on that. So that's all I understood.
Yeah. Peter, is that pretty accurate? That's what I understood too.
Yes.
Okay.
So when we have multiple borrowers, that's when it's going to shine the
Right.
most.
Right. Do you know how is it literally? Do they take an average of? Let's say it's three. Are they going to take an average of three of the scores?
Technically, no,
Uh-huh.
but let's say yes for now.
Okay.
I'll try to find a flyer or ask Michael. There is a one-page explanation about this.
Okay.
I'm gonna search through my email.
Okay.
If we have time, I'll share.
Okay.
If not, I'll share in the email later on.
Awesome. Great. Yeah, I hope you guys look every week. I hope you guys take away something, right? The team is taking time to bring some, speakers on from different wholesalers, lenders. My big takeaway was, I mean, it was at the end, but I don't know if you guys noticed it, but HELOCs, right? More and more companies are coming out with non-traditional or non-QM HELOC programs. They understand there's a lot of equity out there in America. Remind me, was it like 13 trillion equity? 13 trillion dollars of equity, guys. And obviously, not everyone can qualify for it using full doc methods. Right, being restricted at 50% DTI, or they're running their tax returns right now because they don't want to pay Uncle Sam. So notice, in addition to full doc line of credits and HE loans, many lenders are coming out with non-QM ways. I closed one already, or several actually, end of last year, beginning of this year, by way of a P&L and bank statement. I've done both now. So no, just keep tabs on that. That it's they're expanding in that space. And then finally, for me, the other takeaway was the 85% LTV investment. You guys all know by conventional, typically you can do up to 20%, right? But we in the marketplace, we sell 25% down payment or 75% LTV. Why? Because of the LTV, because of the LLPAs, right? You want to sell it ideally at 75% LTV because of the LLPAs, but you can go up to 20. And as I'm learning today, I guess you can actually go up to 15, but 15% LTV on an investment that's actually not a bad rate. Par rate being around in the high sevens, mid to high sevens. It's actually a pretty decent rate. especially when you are trying to sell this to an investor slash flipper, right? Hard money, you're looking at 9, 10, 11, 12%. So, you know, and typically with hard money, you have to do 25, 30, 40% down payment. So this is a great, you know, an option, a product for you to go out and sell. Freddie, did you have a hand up? If you can unmute yourself, please.
Sorry, I think you already answered. I'm sorry.
Oh, okay. Okay, yeah. So that was a huge one. That's why I asked about it personally, because I didn't know of any 85% investment programs. You know, in the few minutes that we do have, I really liked Freddie about a month ago brought up Deal Talk. Okay, we definitely wanted to incorporate this in our weekly sessions here on Tuesdays. I have one to share, so I'll go ahead and kick that off for you guys. And then if you guys have any questions or scenarios that you guys want to discuss, let this be a safe place, an encouraging and solution providing environment for you guys to share any and all possibilities or questions of deals that you guys currently have. Mine is very quick, and forgive me seeing on because I've talked to this about them many a times. I have a client who is of older age. She has dementia now. She has a first lien on very limited income. Okay, Social Security of $1,700 or $1,800 and a small surviving pension. Okay, she, because of dementia, she needed additional medical aid. Okay, like a nurse. So I met her, and she wanted to do a reverse mortgage. Okay, obviously, she needs to pull out cash, and but she doesn't have lots of cash flow. So we submitted this. Brenda and the team submitted this as a regular, convention, a HECM. Okay, a HECM reverse mortgage. It got denied. Why? Because right now, or a couple months ago, so right with we in the Ford mortgage, we use the term LTV. Okay, in the reverse, just know that it's not referred to as LTV. We use something called the PLF, the property limit factor. Okay, regardless. Right now with the rate high, that PLF factor is lower. So contrary to what you and I might think of or believe, you can't even do a reverse mortgage at 50% LTV. The magic number right now is like in the 30s. Okay, so if you're in the 30s, you're going to be able to qualify for a reverse mortgage. Long story shorter, though, the borrower didn't qualify, despite being 73 and having a LTV of about 37 or 38%. She didn't qualify. We're pretty bummed. I thought this was going to be a case closed. I do have to give a shout out here and thank Brenda. After a few days, she goes, "Hey, why don't you consider a reverse second?" Okay, so yeah, you know, on the same vein of seconds, right? There's full doc, there's non-QM, there's reverse seconds now, guys. So this client was able to basically keep her first, and she's able to make her payments, right? Her Social Security was enough to cover her mortgage payment, and she had like a 2.75% rate anyways. And then, so instead, we did a line of credit. And as you guys all know, generally speaking with line of credit's allowed to go to a higher LTV, right? You got an 80% loan on a first, you can still take out a 5% up to 10%, even some places 15%, 95% LTV. Well, the same thing applies here with the reverse second. It allows a higher LTV. And because it allowed that higher LTV, the borrower was able to go up to about like 45 or 50%. And maybe I should bring it up, but in any case, she was able to pull out $110,000, in which she would have not been able to otherwise. And she is actually signing today. So my client is signing today. And yeah, it was a great win. I thank you, Brenda, if you're on the call listening. Had I not known this, it's just been done. I don't know what the borrower would have done, but definitely a win-win situation. So knowing this, if this is something that you guys can sell in the marketplace, go for it. If you come across mom, uncle, grandma, auntie, a neighbor who's of elder age, wants to access equity without worrying about a single payment, a monthly payment, you can sell this, right? Anyone else has a scenario they've been working on, or have something, you need help structuring, or a win for it, for that matter?